Welcome back to Investing Success Video Shorts. Last week the subject was expectations for your portfolio. This week staying with the same theme of expectations when it comes to the market itself. Here is a chart of the history dating back to basically 1925 of the market history and what we can expect from the market. What we can expect from the market is when there's a downturn, there is a greater recovery shortly after. And history shows us. If you're able to see there from your vantage point, the overall trend in the history of the market is what? It's up. Now, after the great market crash of 1929, shortly after, within about 2 years, there was a greater recovery. And those who acted out of fear lost out on that recovery. Then we had World War I, downturn, but afterwards, recovery. Hiroshima, downturn, afterwards, a market recovery. Kennedy assassination, terrible time in our country. Our president was assassinated. The market went down. After that, market recovery was greater. And what does this all mean? When investors give in to emotion and fear, and they even follow the media in getting out of the market and going to cash, not only do they take the loss, but they lose the greater growth of recovery that comes after the market downturn. In the Nixon resignation and Watergate, 1973, 1974, 2 years of downturn. If an investor reacted emotionally and took the loss when the market was down, not only did they take the loss, they also lost a greater recovery in 1975. Some markets went up as high as over 50%. And we would lose that if we acted emotionally rather than staying prudent and disciplined to stay the course in our plan. Black Monday in October 1986. The downturn was so great they closed the market. They panicked with over 500 points lost in the market index in one day. And very shortly after that, greater recovery. And the market continues to grow. We had 9/11, big downturn in the market, understandably. But what happened afterwards? Recovery, market recovery after 9/11. The credit crisis, October 2008, downturn. And again, March 2009, a downturn. What happened after that? The rest of 2009, 2010, recovery. And those who would have bought into, you better go to gold or silver or cash, missed out on the greater recovery. So we can expect downturn. You don't need to act emotionally, take a loss, and then miss out on the greater recovery. Market recovery happens after downturn. One last note this week, oftentimes investors will look at the U.S. as the barometer as how equities are doing. Let's not get in the bad habit, and make the mistake of doing that. Sadly, this country is ranked number 8 as far as economic freedom among the free countries that exercise and provide economic freedom to investors, citizens, and companies. Above us, Australia, New Zealand, Ireland, Hong Kong, Singapore, just to name a few. The U.S. may go down a bit, other countries are going up, and they tend to act in opposite, bringing a properly globally diversified portfolio in balance. So there we have this week's Investing Success video short. Stay tuned next week.